Hi, everybody. Suze Orman here. Now, stay tuned. Why? Because I have a special guest, Keith Fitz-Gerald, and he's going to be talking about everything you need to know when it comes to your money, stocks, real estate, gold, silver, you name it. And at the end, we have a special announcement to make for all of you. So stay tuned. Keith, everybody should know by now who you are. And if they don't know who you are, they can just look you up, okay? Because you've been part of the Women and Money family for quite a while now. First question off the bat. We're in the middle of the day when we're taping this. Markets are up, markets are down. Friday here. What do you want people to know today?
That you're okay. Take a deep breath. These markets are acting normally. There's nothing, despite the headlines, that makes me concerned. We're on target, on path, and on goal, and that's great to see.
Now, that's hard for people given that many of the stocks that we've been talking about are down considerably now.
Yep.
I did a podcast last week and I did a comparison between now and 2022 and all of these things. But it's like, I want you to tell them that it's not just okay, but why? Because they are scared to death, Keith. They should not be scared to death right now because of the dramatic decline in many of the stocks that they currently own?
Well, that's a great question, right? And it cuts to the absolute core of who we are as people. It cuts to the core of who we are as investors. And it's important that we look at history. What's happening now, Susie, is simply a shift in the institutional framework, and it's the world of high finance that is colliding with the world of the individual investor. And we've seen this playbook so many times, we know the script. We've seen from all the way from 1871 to COVID to the Euro crisis to financial crisis, there are always great shifts in liquidity, meaning the amount of money on the move. What's happening right now has nothing to do with the great stocks that we talk about frequently. For example, during the internet crash, people forget that Amazon, one of the greatest names today, lost 90% or more of its market value. Things got so bad that Jeff Bezos had to go around and assure all the shareholders and investors that Amazon was going to be okay. Today, you're simply seeing lots of hugely leveraged financial institutions making decisions, trading with computers that have nothing to do with the underlying merits of owning those particular stocks. If anything, we've got trillions of dollars of value that has yet to be created. So if you think about this like going to a grocery store, Susie, everything you want to buy has just been put on sale again. And a few years from now, if you don't take the opportunity to shop for sale, you're going to be standing there in the aisle going, gee, I wish I'd bought that when it was cheaper.
But how do you know when cheap is cheaper really? A lot of people, they saw a few stocks go from 200 down to 185 to 165 to 150, now around 127. And they're wanting to know, is now the time? Or should I wait? Is it going to go to 100? Is it going to go 70? Should I be selling right now and taking losses or taking gains? They are seriously not knowing what to do and are looking for direction, some solid direction.
Well, we talk about this a lot with folks all over the world, right? And there's really two questions here. If you're selling because you have to, that's one thing, right? I mean, you have a need. You have to fulfill that, whether you need to pay for an education, you need to pay for next month, whatever. You should be investing with money you don't need for at least 5 years. I think you make that very, very clear. But the difference between what's happening now and your emotions running amok is that history shows very clearly that the markets have an upward trajectory over time. Now, part of that is trust the system. Part of that is looking at where you are in the market cycle. But is it cheap enough? You don't know the answer to that, right? But what you do know is that there's a propensity for a rising tide to raise all boats. We are estimating $4, $5, $6, $10 trillion a year coming online, all of which has to find a home in the world's best companies. Over time, that is a bullish input. So really the question is not, should I sell? The question is, why wouldn't you buy? And that's something you got to look in the mirror and take a hard look at. What are you hoping to accomplish? Because if you're buying the world's great companies, then this is no different, again, than going to the grocery store and buying the best steak you can see on the shelf, or buying the best chicken, or buying the best soup, or buying the best ingredients. Because that's really what you're doing, is you're making a soup, you're making a delectable, delicious meal that you're going to enjoy for many, many years to come. So moments in time are not the same thing as moments over time.
So let's talk about those moments in time. One of the things people are always asking is, when is the right time to dollar cost average? Do you do it monthly? Do you do it every 3 months? Do you, when you see the stock go down, do you buy more? And what happens, Keith, when you bought a position, you own the stock, and you have no more money whatsoever to dollar cost average into it? What do you do?
Okay, well, let's take those in order because those are all very important questions, right? So dollar cost averaging is something a lot of people misunderstand. They think it simply means buying lower, but that's not true, actually. If you're dollar cost averaging properly, the big key is consistency, because the whole premise behind dollar cost averaging is that you go in consistently, whether it's the first Monday of the month, whether it's the first Monday of the quarter, and whether it's your birthday every year. I mean, I know how some people do it that way. The point is you don't chicken out when the prices go down, because if you do, then dollar cost averaging doesn't work. In fact, you're defeating yourself at the worst possible moment, because the advantage to dollar cost averaging is consistency, and at moments like the present, having the discipline to keep your emotions out of the equation and buy in anyway, even if you're gritting your teeth and hating every minute. And I personally feel those feelings too, right? I mean, I'm an investor just like you are. But the other part of this equation that people tend to misjudge or misunderstand is, they think they're going to buy low just because it's low. That's not quite right. Dollar cost averaging, again, is about consistency, it's about execution, and it's about discipline. And if you're doing it correctly, you should learn to embrace the sale. You should learn to embrace the fact that many of these stocks are off significantly. If the reasons for which you bought those stocks are still there, the question, again, you want to ask is, why am I not buying? What's preventing me from doing that? Is the story still there? Is Apple still the one I want? Is Palantir, IonQ? I mean, we're going to talk about all those stocks later, but the thing is, think forward, think positive, because that's what DCA is there to help you do.
All right, so one last question about dollar cost averaging, which is, all right, stock's going down. I understand why I should buy it as it's going down to bring my cost basis down. Mm-hmm. But the real question is, all right, we have a stock, and it's going up, and it's going up, and it's going up. Do dollar cost average into it as well as it is going up?
Absolutely, you do that. There's no question, because one of the sayings we have in this office and my team, and it takes people a lot of really internal hard thinking to come to terms with it, is you really make your money when the bears come out to play. You just don't realize it until the bull's running again. And dollar cost averaging helps you stay in the game. It helps you play to win, which brings me to sort of that last part of your third question, which is, what do you do if there's no money, if you run out of money? Well, every time I send out an email, it says, hey, you know what? Maybe you ought to trim, you ought to sell a little bit of this, sell a little bit of that. If you have dividends coming in, if you've got stocks that you own too much of, or something that's making you nervous at night, there's always the art of selling. There's always a little bit you can take from somewhere else. And my answer to people who have that predicament is, congratulations, you're doing the job right. It means you're playing to win. Now, again, that may not feel great because it feels like you're missing a sale, but that's your emotions talking. If you've always got a way in, you've always got a way out, that's what dollar cost averaging is all about.
All right, so when I let everybody know that Fitzy, they're all calling you Fitzy now. How does that feel, Fitzy?
I love it.
So when I was telling everybody on the podcast that Fitzy was going to be on Sunday, even though it's Friday right now, that send in questions. Well, we got about 300 on the wall, thousands in emails. So I decided I'm not going to choose. I'm going to send them all to Robert, the producer, right? And seriously, and I'm going to let him choose, and he'll ask you some, he'll ask me some, and let's just start. Let's do this rapid fire so we can get as many answers in to as many questions as possible. So Robert, now everybody, you're going to get to hear Robert's voice. Can you believe it? There you go.
We got a ton of questions, as Susie said. So I centered them around themes and categories. So these are composite questions, so we're not going to do names or anything. But Keith, we're going to start with you.
Okay.
Given that the growth of AI will require vast amounts of energy and other infrastructure, what are some recommendations you have for new investments in this space or surrounding AI?
Well, that's literally a $1 trillion question. There's a couple thoughts here. First, an obvious is energy. Many people are betting on nuclear development, and that's critical, definitely. But that's also years away because we have a not in my backyard problem anytime we try to build a nuclear plant in this country, even if the permitting is accelerated. So my preference is to think about it as a continuum, and you want to look to conventional energy providers, to natural gas players in particular, because every big AI company, every big data center, every Mag 7 is talking about fueling the incremental demand with natural gas. A company like Chevron is ideal.
Susie, this is about general investing. And the question would be, I don't know when to sell stocks. I can buy them for sure, but knowing when to sell them is as important as buying them.
So I think Keith kind of answered that. You sell, in my opinion, when all of a sudden you're too nervous to hold. Or something has gone wrong in the company. They've changed the CEO, they've changed their strategy, they're no longer relevant, whatever it may be. Keith, what do you think about answering that too?
Well, I agree with you 100%, and there's two sort of litmus tests that we have. The best time to buy stocks is when nobody wants them, i.e. a big drop, and the best time to sell stocks is when people can't get enough of them. And just simple as that. It's like a garden. You trim the vegetables, you prune them, you harvest them every once in a while.
But Keith, I have to say this because the other day on the podcast, I was telling people there are some stocks you just want to own forever.
Oh, yeah.
And you never want to sell. And that caused a ruckus of, well, what stocks are those? How's it possible that there are some stocks you never want to sell? Give them, and I know, Robert, I just took your job away from you for a second, but what are some stocks, examples of stocks that you personally own or I own that I would never want to sell?
Well, I will cut right to the chase, and this is a very controversial name, but I anticipate owning Tesla for the rest of my life and hopefully for my children and unborn grandchildren's lives.
Tell people why.
Well, the reason is that this is a company that is not about cars, it's not about EVs, it's not about, wild executive antics. This is a company that is changing data, it's changing transmission, it's changing energy, it's rewiring humanity. And so the question people often bring to me is, well, I can't get past Musk or I can't get past this. Great, because that means there's controversy. Controversy creates opportunity. If you look at all of the trillions of dollars of things that he's doing through those companies, I think we're looking at a transformational moment in human history, which is why I hope I'm smart enough to buy more shares over time, regardless of whether they're up and down. And if I don't have money available, I'm going to make some money available.
But in your opinion, there are certain stocks that you've probably owned for years.
Oh, yeah.
You probably will continue to own for years.
Yep.
So it's those types of stocks that you really want in your foundation to build upon. Because in my opinion, everybody, you don't want to pull out your foundation. You pull out your foundation, everything on top of it will crumble. So you always want foundational stocks in your portfolio. Robert, what's the next question?
So related, where can people find reliable information as to what they should invest in?
Well, I want to change that a little bit. I think people, what they really want to know is, Keith, where do you get your reliable information that you pass on to everybody?
Well, I would make a joke about the magic 8-ball, but that probably wouldn't go over very well. You remember those? You shake them and you get this great answer.
No, well, that's where I get it from, but don't tell anybody.
I know.
Okay? All right.
The best part, the key to getting past the noise and the nuance and the hype is you actually go to the most interesting part of any corporate website or any corporate annual report. Forget about the numbers, forget about the analyst calls, forget about the research you're getting from people like Big Shortimus Maximus, Michael Burry right now. What you want to do is look at the notes for any earnings call, because the executives can't lie. They have to meet certain accounting standards, they have to meet forward-looking statements, all of that. But the really interesting stuff is almost always in the notes. And
Which is why then, right, people come to somebody like you, or they come to me or whatever, and they look for guidance there.
Yep.
So everybody, I know you all want to know, should I have a financial advisor? Should I do this? I doubt highly that many financial advisors that all of you deal with, by the way, do that research.
Bingo.
What they do is they take the research of the firm that they are with
Yep.
and everything, but they have to add to that they have to meet sales quotas sometimes. They have
Yep.
to make money sometimes that way by buying and selling and everything. So just keep that all in mind. But there are ways for you to have reliable sources that you rely on to find out what you need to know. Next question, Robert.
Well, Susie, you just mentioned financial planners. When do you know that it's time to get a financial planner or not use a financial planner?
I have to tell you, I have a saying, and I've always had the saying, you want to find the best financial planner in the world, people, look in the mirror. Because
Bingo.
nobody is going to care about your money more than you do. And what happens to your money directly affects the quality of your life, not your financial advisor's life, not your banker's life, not your insurance agent's life, but your life. And recently, a woman asked this question about her husband having Parkinson's and should she go and give her money to a financial advisor. And it's like, I would hope all of you become the masters of your own financial destiny. And you all understand that you have the ability with the right information to make the right decisions to keep your money safe and sound. Now, if you have seriously large sums of money, millions of dollars, then maybe then it can become a little bit burdensome. Maybe then you want to employ a financial advisor. But you better know that that financial advisor is a fabulous one. Not just because your friend says they are or this one says it is, but you better absolutely know they have a track record and they are worth it. Otherwise, I have to tell you, I would really rely on myself. Next question. I already know Keith agrees with that, so I'm not going to ask him what he thinks. Go on.
Yes, I do.
All right, so we had a number of folks that said that Keith suggests an almost 100% individual stock portfolio, while Susie suggests 50% in the S&P 500 and the remaining in mostly individual stocks. Now the folks want to know which approach should they follow.
Well, I got to tell you the truth. I got that approach from Keith. Right? I actually had written a letter or an email to Keith saying, somebody wants to know what they should do with this. I'm not exactly sure. What do you think given who they are and everything? And it was Keith's suggestion that that's where that came from. So, Keith, you answer that now.
Well, there's a nuance here, and it's not quite an accurate reflection of the real question at hand. You know, if you're just starting out and you need to do that, Susie has properly, appropriately, and profitably talked to you in the audience for years about using index funds, using ETFs, using those as a way to get started, get your toe in the water, get some mileage under your feet, right? As your portfolio matures and grows and you begin to have additional money you can put to work, or maybe you're starting to move into a different phase of life, that's when it really becomes appropriate to concentrate. And what my research shows is that many investors begin in the fund world and then over time begin to add more and more individual stocks to their portfolio because they are able to achieve their own personal objectives. And in our world today, diversification no longer works the way it once did. That doesn't mean it's irrelevant or wrong. It just means that what you need to do is add stocks like NVIDIA, for example, to a simple ETF portfolio. The ETF portfolio is going to do very, very well, particularly if you layer that extra salt and pepper, the NVIDIA, on top of it. And I'll give you some hard numbers that'll make that case. If you look at the average percent of the S&P 500, you're 100% or so, maybe 150 over the last, 15 years, 20 years. But NVIDIA, even just a small $1,000 investment in NVIDIA in 2011, mid-2011, is worth $509,000 today. So imagine what happened if you had diversified appropriately, properly, and you added just a little bit of spice. That's the difference that having a blend of those two approaches can make in your life, especially in today's volatile markets.
Think about it, everybody, as adding salt to the soup.
Bingo.
To make it taste a little bit better.
Yep.
All right. We have time for a few more, Robert?
Absolutely. Should someone use extra income to pay down their student loan, or should we keep making monthly payments and send extra income to their Roth IRA?
Well, I can tell you this, student loan debt, in my opinion, is the absolute most dangerous debt you can have, bar none. And why is that? Because it is not dischargeable in bankruptcy, and it will follow you to your grave. I am not kidding. If you haven't paid it off, you're now collecting Social Security. They have the legal authority to garnish your Social Security, even your wages. So for me, depending on how you feel about your student loan debt, how much you absolutely still owe on your student loan debt, I would do both. You know, please don't be an all or nothing type of person. All my money's going to my student loan debt and all my money's going to my Roth IRA. I would do both. And the reason that I would do both is, remember, every year there's a maximum of what you can put into a Roth. So if you miss those years, then you don't get as much money into the Roth. So I would do both. That's the answer there. Next question.
We had a number of questions about precious metals, specifically gold and silver. So this is directed at you, Keith. What's your outlook on a gold position long term? Would you buy physical gold or ETFs? And then there's some silver kind of goes in there too. A lot of folks were asking about silver. That's starting to pop up more.
Well, at the risk of committing financial heresy, let me tell you why I would not buy either of those right now. It has nothing to do with the metals. You know, people think buying metals right now is a hedge against inflation, which is not true. It is really a reflection of rates. Are they rising or falling over time? The problem in today's markets is not the gold or the silver or other precious metals themselves. It comes down to hypothecation and reborrowing of funds and leverage. The reason gold and silver got shellacked recently and why they've risen so much is absolutely the same. In the old days, an ounce of gold used to back a single financial product. These days, there are single stock derivatives, there are fund derivatives, there are ETFs, there's mutual funds. So there's about 8 or 10 claims on every single ounce of gold out there, all of which trickle through the financial system. So that magnifies price movement up or down, or up and down, actually, really. And so knowing the game is what it is, and seeing the global volatility lately, everybody's trying to figure out who's got the real dollar in the system, and stuff like that is just going to get caught in the mix, and I have no interest in doing that. I'd rather buy a dividend producing company like Chevron, because now I know I've got a resource, I've got solid management, I've got a dividend, and importantly, I've got growth potential. If you've got gold and silver, you may think you're playing smart, but the reality is you're not earning a dividend, there's no management, there's no product, it's only worth as much as the next person coming along is willing to pay you. And with the institutions in the game, the risks are a lot higher than people think.
So I just want to add to that for 1 second, is that a lot of people feel that they want to participate. Yep. They don't care about anything you just said.
Yeah, I know.
They want to participate in it. And what I've been telling them, all right, if you want to participate now, put a little bit of your money in an ETF, the GLD ETF. Yep. But a lot of people are doing what? They're absolutely taking advantage of gold at Costco. They want to own the physical commodity. And I'm telling you, everybody, that will be the biggest mistake you make, bar none. What else you got, Robert?
We had a number of questions about real estate. And this one really stood out to me because I think that folks might need a refresher on what you've done, but I'm interested in Keith's opinion as well. Suze, I have a feeling you sold all your real estate because you think that the real estate market is going to be obliterated.
No, that's the stupidest thing I've ever heard, right? Absolutely not. We sold all of our real estate very simply because we didn't need it anymore. When I was younger and I was touring and we went all over with my career, we were in San Francisco, we were in South Africa, we were in New York, we were in all these different places. So we had homes there to serve us because truthfully, rather than renting a hotel, everything, because people were paying me to be there. Also, everyone. So rather than paying me to stay in a hotel or whatever, it was like, all right, pay me my condo fees to do this. And we made a lot of money doing that. because real estate went up. We have sold all of our real estate except for our Florida condominium because we really didn't need it anymore. We're now older. We wanted to downsize. Just that simple. Had nothing to do with the real estate market. Keith?
Well, I'm nodding because I resemble that remark. We have gradually been selling off our real estate around the world because we're getting older. Our kids are grown. We simply don't use it like we used to. And we've put that money into the markets. I've put it into a few of my motorcycles. My bride is putting it into her cooking equipment, which she loves. So it's about what are you going to do with it, not necessarily a reflection of the markets themselves. The distraction that you get in the hype is, okay, home starts, home finishes, sellers withdrawing, that is just all noise, food for the gristmill. If you need the real estate, own it. If you don't need it, don't own it.
Yeah, I just have to say one other thing. I have never found that having an asset like real estate as an investment for me is particularly smart. Why? Because I have expenses that I need to make to keep them. Property taxes, insurance, maintenance. Yep. I have all kinds of risks like Mother Nature. I have risk of selling, which means I want to sell something. It took us 1 year, everybody, to sell our island home. Think about that. If you need money and you're invested in an REIT or in the stock market, put it up for sale. Guess what? It sells. Buyer, seller, just that simple. That is not true in the real estate market. So for me, I don't particularly think real estate is a great investment. However, that's for me. Is it a great place to buy when you want to call it your home? Oh, you betcha. But that's just what I think. What do you got, Robert? How much more time we have?
We'll do a couple more questions here. Keith, you mentioned bears and bulls at the top of the episode here. How can the average person tell what stage the market is in?
Oh, this is a really interesting question with a very simple answer, actually. What you need to do is just open your eyeballs and listen to the people around you. If you go to the supermarket and everybody's talking about, oh, you got to buy this, you got to buy that, you're probably in a euphoria stage, and guess what? That's a time to be selling into strength, particularly if you're dollar cost averaging to raise cash for the next downturn. Because the herd makes the wrong decision 85% of the time. If you're listening to everybody and they're scared out of their wits and you understand history that we've just talked about and you know that every single running of the bears has been followed by a greater running of the bulls, that's the time to buy. So investing doesn't have to be complicated unless you want to make it that way. Don't overthink it. Keep it really stupid simple, in fact.
All right, so I just have to add something here, not about that, because I know we're coming to the end of the podcast. There is one question that everybody, I know Robert has it there somewhere. What about Palantir? What about IonQ? Do you still like them? Do you still want to buy them? Should we sell them? Especially those two stocks, because I looked at some of the questions. Everybody wants to know about them. Tell them.
Oh, my goodness. All right. I can't advise any of you listening individually. If you want to sell them, sell them. Don't let the door hit you in the rear on the way out, right? That's just the deal. But if you're looking for foundational companies that we spoke about, you're looking at companies that are going to change the course of humanity. You're looking at companies on the breakthrough of truly new technologies that mean something to our planet. I would respectfully submit there are probably no two better candidates anywhere out there. And yes, I own both of them. I don't intend to sell them. I probably will hold those for the rest of my foreseeable future and or life.
And can you tell people why they have gone down so much? This is going to get to him. Watch what he looks like right now or listen to his voice. All right. Why are they going down?
This stuff makes my brain explode. Both of these companies are doing very well. They're doing very innovative things. Their customers cannot get enough of what they're buying. These are not companies in trouble. What you are seeing in Palantir's case is there's an individual named Michael Burry who was famous for The Big Short, and everybody's running around going, oh, is Michael Burry correct? His analysis is flawed. He's predicted 10 out of the last 2 recessions. He is comparing apples to oranges. And I think if there were a serious investigation, it would be found that people like Mr. Burry have engaged in systematically manipulating the stock lower. And so, I'm not alleging that. I don't want to get sued. I want to be clear. I don't know the answer to that. But I think there'd be a high probability that there's a lot of funny business going on, none of which has anything to do with the underlying value of the stock. IonQ is another one that is in the social meme space. It is highly leveraged. There are people making bets all day long on whether it's going to go up, whether it's going to go down. People are talking about the AI trade. Is it going to fail? Is it too much? Are they ever going to make money? They're completely ignoring the fundamental issue, which is this company is breaking through into an entirely new computing space. This is on par with the introduction of the chips, the introduction of the internet itself, the way we transmit and receive data, how data actually functions. I don't think it gets any better than that. So if you want to listen to the noise again and you want to sell, you need to sell, do it. I'll be happy to pick up your shares if I've got the cash.
So I know, like I said, we're coming to an end here. So I have two questions for you. Number one, people feel like the AI space is absolutely going to destroy their job. Their unemployment's going to go up, that there's no way it can continue on. Comments on that, Keith?
Well, I think that's, fear is real, right? And I get it. The unknown is always that way. But I think all the data I've seen, all the scientists I've spoken with around the world, the exact opposite is true. I think that 65 to 70% of the people who are working today in fields that they think they understand will be working in entirely new fields that we don't even understand or exist, jobs that don't exist yet. And the parallel is agriculture. As recently as the early 1900s, 95 to 98% of America worked in agriculture one way or another. And if you had walked into a grange and said to everybody in the room, hey, 98 of you are going to be out of agriculture 100 years from now, you would have been laughed out of the room. But that's where we are very much with AI. So the risk is not losing your job to AI, it's losing your job to somebody who knows how to use AI. It's an opportunity, it's a tool, and I would respectfully submit to anybody who's fearful about this that whatever field you're in, learn how to use it because it's a tool. And if you know how to do it, then instantly you are more valuable to your employer or to whatever it is you do for a living.
All right, and then the very last question, and one that I'm so excited, since I know the answer to it, is everybody wants to know, when is we going to bring out this ETF that we talked about almost 2 years ago? When is that going to happen, sir? The floor is yours.
Oh my goodness. All right, people, here's some big news. Now, Susie and I have been working on this for a very long time, and the reason we have not been able to talk about this is because there are very strict rules about regulated securities product. But as of yesterday, I filed with the SEC for a portfolio that we intend to release when they are done vetting it and when they are done approving it. I cannot talk about what's in it. I cannot talk about what it is. I cannot talk about when that's going to launch because I am prohibited by law from doing so. But what I can tell you is the ticker is going to be FITZ, Fitz, and you will hear more the moment I can tell you.
I wanted him to say Fitzy, but he said, no, I'm just going to stay with Fitz. So it is coming. It is out of our hands by all means. It is now in the hands of the bureaucracy, but we're working for you. We're working for you to give you an alternative, for you to say, oh, I don't want to buy individual stocks. I don't know quite what to do. I don't know when to sell. I don't know when to buy. Well, soon you probably aren't going to have to worry about that. Any closing comments, Keith?
Keep the faith, everybody. This is tough. It's emotionally uncertain. But uncertainty and chaos create opportunity. And if you can come to terms with the person in the mirror that Susie mentioned, you know what? Everything is going to be okay. The sun's going to come up tomorrow. You just don't know it yet. So thank you so much.
So until next week, there's really only one thing that we want you to remember, which is we love Fitzy. We love talking with him. And as always, people first, then money, then things. All right, all of you, stay safe. Bye-bye.